Have you ever wondered why your moving average-based strategy often fails? The indicators and strategy seem so simple, and yet, many times, the moving average-based trading turns into losses. Regular moving averages are lagging indicators. A lagging trading indicator is a technical indicator that provides a signal after the price movement has already occurred. This means that lagging indicators are not as good at predicting future price movements. As a result, by the time you decide to enter a trade based on the moving averages, it is likely that the trend has already passed and you missed the right entry point. This can be resolved with indicators that reduces the lag, known as the zero-lag moving indicators. In this video, we will be showing a simple yet powerful zero-lag exponential moving average, or ZLEMA indicator, that will help identify the trading entry points and make profitable trades consistently. So, watch until the end and subscribe to the channel for more content like these. The exponential moving average, or EMA, is a type of moving average that gives more weight to recent price data. This means that EMA is more responsive to price changes than other types of moving averages, such as simple moving averages. The EMA can be used to identify trends, overbought or oversold conditions, and support and resistance levels. To identify trends, traders can look for crossovers between the EMA and the price. A crossover occurs when the EMA crosses above or below the price. However, EMA is a lagging indicator, and it is important to remember that lagging indicators are not always accurate. They can be delayed, and they can also give false signals. This is where the zero-lag indicators come. Zero-lag indicators are a type of technical indicator that is designed to eliminate lag. Lag is the time it takes for an indicator to react to a price change. Zero-lag indicators attempt to react to price changes instantaneously. There are a number of different zero-lag indicators available, but they all work in a similar way. They typically use a mathematical formula that considers both recent and historical price data. This allows the indicator to react to price changes more quickly than traditional indicators. Zero-lag indicators are useful for traders who want to identify trends and changes in trends more quickly and identify overbought and oversold conditions. Zero-lag exponential moving average is the type of moving average that is designed to eliminate lag. In other words, it eliminates the time it takes for a moving average to react to a price change. ZLEMA attempts to react to price changes instantaneously by using a mathematical formula that subtracts older data from the EMA calculation. As a result, the ZLEMA indicators can do everything an EMA does, but it is more responsive to the price change. Now that you know what EMA and ZLEMA are and the difference between these two indicators, let's look at how the ZLEMA can give you entry points for your trading. The 2-0-lag EMA we are going to use is the 240-period ZLEMA for tracking the long-term trend direction and a 21-period ZLEMA for highlighting the short-term price changes. The specific periods can be changed depending on the trading style, but the more important thing to consider is the consistency in the strategy. For a long trade, first the 240-period line should be moving upwards. This indicates an overall market uptrend. Longer period moving averages are less responsive to short-term price fluctuations and are slower to react to the changes in the market. The next check is with the 21-period moving average line, and for this, we need to look for a specific pattern. You should look for where the 21-period moving average line is making higher highs and higher lows. Higher high and higher low are two technical analysis terms that indicate a bullish trend. A higher high is a price point that is higher than the previous high, while a higher low is a price point that is higher than the previous low. The market does not move in a straight line, and it is always going up and down. This is especially true in the short term, which the 21-period moving average line indicates. When prices are making higher highs and higher lows, it indicates that there is upward momentum in the market. This is because buyers are willing to pay more for the assets and sellers are willing to sell for less. So, after the price has made higher highs and higher lows, if the price opens above the 21-period zero-lag EMA line, that is your entry point for the long trade. But it is very important to check if the price does not follow the higher high and higher low pattern and drops below this pattern, then this setup becomes invalid and you should not make that trade. Similar to the long trade, the rule for a short is similar, but the opposite. First, the 240-period ZLEMA line should indicate a downtrend. Next, a 21-period line shows the lower highs and lower lows pattern. Lower high and lower low indicate bearish pattern. Along with the long-term ZLEMA downtrend, this indicates that the price will drop in the short term. After the lower high and lower low patterns are established, if the price opens below the 21-period ZLEMA line, that is the entry point for a short trade. Again, it is very important to note that for the short entry, the pattern must hold. If the lower high and lower low patterns are broken and the price goes above the previous low, then the setup becomes invalid and it is not safe to enter a short trade at that point. Here are a few more examples. Of course, no indicator is 100% accurate. This indicator will give you a good idea about the market trend, but you should always look for multiple confirmations before you make a trade. I hope this video was useful. If it was, leave a like and share a comment on how you will use this in your trading journey. Please subscribe to the channel for more videos, and thank you for watching.